Hey guys, how you all going? It's Philip from Opes Trading Group. Thanks for joining today's webinar. I've got Alex with me as well.
Hello, hello.
So we're just doing this webinar today to discuss a bit about liquidity traps and how to avoid them and actually profit from them. Thanks to all of you that actually joined last week's webinar. This will be recorded and it's being recorded at the moment. And for all of you who don't know, last week's is actually up on YouTube. It's on my YouTube. It's on Alex's YouTube channel also. If you want to go have a watch over that. So let's get started.
Before we get started, in the previous webinar, we kind of done like a little introduction on forex, like a few basics. We covered like psychology and mindset, and then we jumped into like a few technical things. In today's webinar, it's a little bit more advanced. So like if you don't completely understand or grasp all the information we're giving you, it's highly recommended to listen or to at least watch the previous webinar, which is on YouTube, as Philip mentioned.
Yeah. So first things first, guys, is what I want you to do is just in the chat, I want you guys to say either a yes or a no for who's heard of order blocks or accumulation or distribution zones. Just put a yes or a no in the chat, just so we can know. Okay, there's a lot of yeses. That's good. Anyone
It's a
here who
familiar
doesn't
topic.
know? Anyone who doesn't know? All right. So pretty much order blocks, accumulation, distribution zones, they're market behavior that pretty much indicate the collections of financial institutions and banks. So we all know that, you know, obviously financial institutes and central banks are what drive the forex markets. And it's very important that traders know what they are doing. And I discussed that last week in who the market participants are and why we should know who they are and what they do. So when the market builds an order block, it pretty much moves like a range. And I've taught this to my students in the course. So if the price is moving upwards and then takes a break, this is what's known as an order block or a distribution zone. And the same when the market's in a downtrend and then finds itself ranging, you could say at the bottom, that's what's known as an accumulation zone. Now, the order blocks is, as we know, the big institutions and the banks, their smart money is what we also call it. They're trading based on the availability of the price, right? So if a bank wants to buy, let's say, $100 million worth of orders on any pair, let's say USD CAD. Now, the orders aren't going to get filled all at once. The institutions aren't going to just place $100 million order at this point. So what's going to happen? It's going to find itself placing the trades in several, what you would call several steps in order to fill all the orders. So you might find them that they enter first time with 10 million, 20 million, another 10 million. And this is what causes these order blocks to form. And now the price has to find the price in order to grab it. It always has to find the nearest price to get it at. And this is where the concept of the liquidity traps and where they come in into the order blocks. So it seems like a range, but not every single range you look at on the chart is going to be an order block. It's very important to also remember that. So now I just want to go onto the charts. Okay, so looking at GBP AUD, when we're looking at the price around this region over here. This over here is what's known as an order block. And this is the liquidity trap and what we're going to try and avoid in trading, because this is where a lot of traders get trapped. They enter the buys, they find themselves getting knocked out only for the price to actually move up right after it. So if we're looking at the GBP AUD on the bigger time frames, this is the weekly. This is what the order block looks like. So when we drop down onto the daily, you can see it looks like a range over here. Now going back to the weekly, you can see that there is a major trend line from the bottom coming up. And there is an area of, sorry, I'll just draw that a bit better. There is an area of supply and demand around this region over here. Now, when the price found itself coming down, a lot of buyers started entering based on the price action of these candles on the weekly over here. Now, the price has to find the closest order in order to, the institutions have to find the prices of the closest for their orders. Alex, do you want to describe this? Because you described this a little bit better.
Yeah. So when large institutions or smart money put their orders in the markets, it's different to us retailers, right? Because we're trading like whatever, it could be micro lots, mini lots, or standard lot sizes. It could be 10 lots or 100 lots. These type of orders get filled instantly, right? Because of the liquidity that we have in the currency market. Whereas when institutions are taking orders, they're taking, you know, millions and hundreds of millions of dollars worth of contracts. So those orders, they're filled in separate kind of orders. So let's say you have a massive order of 100 million contracts. Well, it's going to get filled in pieces, just like when you're buying or selling cryptocurrency, you get filled at different prices because there's a lack of liquidity. Same thing with stocks that are not blue chip companies, but like stocks that aren't as liquid as, let's say, the Apple stock or Google or Tesla and whatnot, right? So to fill your order, they're filled in pieces, and this is essentially this phenomenon here. Can I annotate? Yeah. So this area over here, it kind of shows like a lack of when there's a lack of liquidity in the markets, essentially that one big order block is being filled at a certain price, and then it's going to get the next best price to fill it, right? Until it's all filled. And this usually creates a wick on an important time frame, and then you can see like the body kind of close back in that range and then continue in the direction it's supposed to go. On a technical perspective, these spikes to the downside, when you can't really explain the spike in a certain direction based on like the fundamental and like the sentiment, most of the time those are liquidity grabs or liquidity pools or whatever you call it, you know, manipulation and whatnot. And yeah, essentially a lot of people mistake this concept with, you know, the broker being against you and trying to like knock you out or steal your money or whatever. That's false. Brokers don't do that. Brokers are just, you know, an intermediary between you and the markets, and they give you access to the financial markets, right? They make money long term through your volume and not through you losing money. Because if you lose money, they're going to lose you as a customer, and you're going to stop trading, right? So that's a misconception. This is really just like these phenomenon here. They're caused by lack of liquidity because there's these big order blocks that needs to be filled. And when there's not enough orders to be filled at a certain price, it's going to go to the next best price and the next best price. And then it's going to go in the direction that it's meant to go.
And in this case, the next best price was actually the trend line. That was a major trend line, which came down wicked. And if you guys know your price action, you can see by this hammer candle over here that it did reject and the price did actually go back up. So a lot of retail traders might have found themselves shorting based on this breakout, only to find out it was a what you would call the fake breakout, or the liquidity trap that we're talking about.
And you can kind of identify this based on the weekly time frame. If you're kind of aware of the higher time frame environment that you're in, you can avoid these. I mean, don't get me wrong, you can profit off of this move for sure. You know, like this is the daily time frame. You can profit on an intraday level. But if you're looking to trade, you know, higher, I guess like bigger moves or bigger waves, on the weekly, you know, like this area here was all a supply and supply and demand zones are usually areas where there's, you know, liquidity to grab, which is what happened over here. So they're just more powerful than normal support and resistance levels. If you take that into consideration into your trading, you can kind of avoid these moves getting trapped in those. If let's say you're buying at this level here, you can avoid this whole drawdown and kind of wait for the price to come back in, and you kind of understand what just happened, so you can enter and avoid, you know, sitting in drawdown for a few days or whatnot.
That's right. I wanted to show. So also, Alex, as you would trade the lower time frames. So for you guys that are wondering if this works on the lower time frames, yes, it does. And me and Alex both do use them. Alex uses them a lot on lower time frames. The concept does work on the
Yeah,
small.
so it also applies on lower time frames, and these grabs of liquidity um, tend to happen around peak session time. So I usually trade, you know, London session, and you can see those grab of liquidity around an hour prior or an hour after the actual open. And if you wait for those grabs of liquidity and you wait for price action confirmation, you can, like I was saying, you can avoid sitting in drawdown, or you can avoid being wicked out on your stop losses, like getting stop hunted or whatnot. So by being patient and kind of identifying these things that happen in the markets, you can enter in trades and increase your probability of being in the right direction, right?
Mary's asking, what does it look like on the weekly? So this is what it looks like on the weekly. So
It's
this
just a big wick.
liquidity trap. So this is what would have made a lot of people enter sells, only to find themselves, you know, at the end of the week, the weekly closed as a big hammer of some sort, only to move back up. So this is the liquidity trap we're talking about. Now, I'm going to take you to another example. So NZD JPY. This is a live example. So the move has not happened yet. So another example of an order block, daily time frame. If we go back to the weekly, we can see that NZD JPY is actually in a big downtrend. Looking at this region over here, we can see a big order block. Now dropping down on the daily, this little move over here is what you would say is the liquidity trap. A lot of people would believe this is the breakout, but if you were looking at the bigger time frames, you would understand why the price is not necessarily moving in a bullish manner, only to find it coming back into the order block. A lot of sellers would have entered sells based on the highs. Their stop losses would have been somewhere around this region. Let's measure the value. So the highest was around the 50 pip mark. A lot of sellers would have found their stops there. Liquidity trap once again, only to find the price moving back down. So this is another example. We're going to wait for it and see what happens in the future.
You can kind of see as well here on the weekly time frame that breakout was just a wick,
Yeah,
you know, to the upside on the weekly, and it ended up closing and respecting that resistance level. So like
right.
you can kind of anticipate the move to the downside.
And that's another thing, Alex, is a lot of people actually ignore the weekly time frames. They're just looking at the daily. On the daily, they see a breakout. Even the 4 hour, which is another popular time frame, they see another breakout of some sort, and they think that the price is going to move upwards now. It's finally broke out. And this is the whole concept of the liquidity traps and avoiding them.
That's right.
All right. And there was another example I wanted to show you guys, which was gold. And I know that a lot of people were looking at gold. So as you might have seen, for the guys that follow me on Instagram, or my students in the group, so gold has been moving in a pennant formation. This is the 4 hour. This is the daily. It's moving in a pennant formation. So pennant formation is where the price is pretty much squeezing into a point until it finally breaks out. Looking on the 4 hour, around this region over here was the week of NFP at the start of this month on the Friday. The price was nearing the bottom of this pennant over here. And what happened is the price actually broke out of the pennant. Now, why my entry was here, and a lot of people were wondering why I took my entry at the 1910 mark. And there's a reason for this. So once again, this area, from what you can see, is a major zone for institutions and banks to enter their trades as buyers. Now, what happened is this is a big liquidity trap in itself between the bottom of the pennant and the order block that was here. So a lot of retailers found themselves selling gold based on the positive news that came out after NFP, and they saw the break of the pennant. So they automatically assumed that the pennant is broken, the trend line is broken, the gold is going short. Now, as gold went down, it found itself going down to the order block of the 1910 region, where a lot of big institutions and smart money was waiting with their buy orders, only to find the price just going back up and breaking back into the pennant. So this is another example of, you could say, a liquidity trap, where the smart money was waiting down at the order block and the retailers assumed that the price had broken the pennant and the trend line and just started shorting gold from there. It's very important that you start recognizing these things, start paying attention to order blocks, direction of the pair, looking at the higher time frames, and always trying to avoid these liquidity traps and avoid the chain of thought that the price has broken a zone or a range only to find that going back in. I know a lot of you guys might have found yourselves trading a range. If trading the breakout, you think it's going in one way, and then as soon as it goes in one way, it just goes right back into the order block or the range. Alex, I'm sure you've experienced that. I've experienced it when we first got started.
Yeah, I was kind of answering the a question that was asked by Matthew. So he said, all right, so how can you trade break and retest if you can't be sure if it's either actual break or liquidity trap? So I gave a quick answer. You can trade it based on an intraday perspective and still profit from the move. And even if it was a liquidity pool or a liquidity pool or a liquidity trap on a higher time frame, right? Because if you wait for your confirmation, your candle closures, you can get a break and retest on the hourly time frame or the 4 hour based on the structure on that time frame and still catch a move. Now, if you're trading, the 1 hour time frame, the 4 hour time frames, you can expect to catch 200, 300, 400 pips on a move where you would expect to catch, let's say, on the weekly time frame or on a weekly time frame structure, right? So you have to adapt. You have to adapt. Your trading based on the time frame that you're trading off. Now, if you want to trade a break and retest based on a weekly time frame or a daily time frame, you need to wait for that confirmation on that time frame you're looking at. So if you have an order block at a certain level and you can clearly see the weekly broke out of that area, usually that tends to mean like it's going to change direction, or it's going to go in the direction that it broke. But if the weekly ends up just wicking and closing back into that range, it tends to respect that range, right? So it's just a matter of understanding your time frames and adapting the trade based on what time frame you're taking it on. So you can wait for that weekly candle to close if you want more confirmation, and then go down on your time frames like the daily or the week or the 4 hour, and take a trading decision based on the information that you have on the weekly time frame. So it's not just like if you see a close or a candle on the weekly, then you trade based on the weekly. You can wait for that weekly candle to close, then take a trading decision. So that's where like patience comes into play in trading. It's not just about taking as many trades as you can on a daily basis. And later on in the presentation, I'm going to talk about my process to being funded with Ftmo and another company, and you'll kind of see in my process, in my evaluation process, that I didn't take trades on a daily basis, especially in September. I think I took like 4 trades in 2.5 weeks, and it just shows that less is more. And if you're patient and you can wait for those signals, or for that information that you can get off of, you know, a higher time frame, just to get a better idea, or a better a better idea of where price is going to go next, it's actually more profitable than just always jumping on signals on lower time frames, for example.
And that's also, so to add on to your answer, Alex, is how do you trade the break and retest if you can't be sure? Well, first things first is there's a range of things. On top of the break and retest, there's something called confluence. So most likely, if you have the confluence of many other things, such as trend lines, fibs, support and resistance, and all the rest, you know, your moving averages, that's going to put the probability more in your favor, firstly. So you're not just trading based. I know me and Alex hardly ever trade off, you know, just the break and retest, and that's it. We don't look at anything else. Also, let's say you do trade the breakout. There's another thing that's very important. It's probably the most important thing in trading, which is risk management. So if you do want to trade those kind of trades and you enter, it's very important to, for example, put your trade at break even as quickly as possible. Because then if it is a liquidity trap, well, you just end up closing the trade at break even and nothing happens. And then you get the picture of the liquidity trap. At least you didn't lose any money. So there's many ways of trading it. Just because you don't know what it's going to be, well, trading in itself, everything is unknown. Anything past, you know, the most current candle is unknown. Nobody really knows. A lot of people, you know, a lot of people predict what's going to happen, but no one knows for certain what's going to happen. And that's one of the most important things to remember.
That's right.
Is there anything else you want to add on, Alex? Is there any other questions in terms of what we've spoken about so far? If you guys just want to write in the chat, you know, if you guys get it, if there's anything, any additional information you'd like to know.
And you can also look back on your charts and kind of see those order blocks and that wick or manipulation or liquidity grab. You can spot them fairly easy. And usually, like when that happens, you get a big move out of it, especially if it comes from like the daily time frame or the weekly time frame.
That's right.
Okay. Okay, there's a question. Can you go through the way that entered this gold trade, i.e. your confirmation, etc.?
Yeah, so like I was explaining why I entered gold on this. So going on the higher timeframes like the daily, all I did was pretty much look left. And as you can see from this whole region over here, this is what this is how I determined this is a major, you know, order block region. A lot of institutions, banks are going to be waiting for this region to fill their buy orders. And once the price is going to reach this area, all the, the smart money is going to kick in with all the buys. And I knew that this was around NFP, as I was saying. NFP news came out really positive for the USD. So since this is, gold, with the US dollar, since the US dollar was positive, this was expected to move down. And this is what retail traders did exactly. So once the pennant broke, as I was explaining before, you found a lot of people selling gold against the USD just based on fundamentals and the positive news towards the US. As the trade moved down, now 1910, why I chose that number, one, it's a psychological number. It's a nice round psychological number. Two, as I said, looking left, it's a major area of support on the daily. And all the retail traders that found themselves selling here, their stops would have been around the zone that is drawn right there. So there was a high area of liquidity for the buys and to get fulfilled. And that's why I entered my my buy on gold at the 1910 region.
Can you go back on the daily time frame? I want to show something to the guest. So having you can clearly see a support level in this area here, but all these wicks here, they previously acted as liquidity, right? So this is kind of like a liquidity pool. So you can kind of expect, even though you have a like a support area over here, when price goes down in that liquidity pool, it tends to be an area where it grabs liquidity. That's where the liquidity pool concept comes from, right? So you can kind of see why, an entry in that area where that liquidity pool is important. Now, if there was a candle that closes kind of below this area, it kind of gives you an idea that, okay, like there's a lot of bearish pressure and it can go a little bit lower and maybe go into this liquidity pool here, down here. So it's a matter of, it's a matter of confluence as well, right? So you wanna have as much confluence as possible to give you an indication that, okay, this is an area of liquidity, and the overall move is gonna go to the upside.
And also to add on, so a lot of traders might have said, okay, it's found support. They would have seen a few daily candles like this, and they said, well, this is where the whole FOMO, the fear of missing out, and patience really has to come into trading. You have to be patient enough, because this is exactly what the smart money is actually waiting for. They're waiting for the impatient to enter their trades, so then they can grab their buy orders down here with the liquidity. So this is why patience is very, very crucial in trading.
Oh, and something that people might not know, if you're entering, let's say, a trade based on like this support here, and you're entering here, you're setting your stop losses, I don't know, below some certain candles, right? Like any other retail trader. These stop losses act as liquidity, right? So if you want to buy, if you're buying and you have a stop loss, once the price hits your stop loss, it acts as a sell, right? For buyers. So in forex, it's a zero sum game, right? So if someone's buying, someone's selling. If someone's selling, someone's buying. So your stop losses act as liquidity for the main move. So if you enter, let's say, in the wrong session or not at the right time, you can get, that's how you end up sitting in drawdown or getting wicked out, because your stop losses are used as liquidity. So for those big order blocks, there's all these stop losses that are that people will set, and they act as orders to be filled for those bigger order blocks.
Yeah, and this is exactly what I meant by this order block is going to be a very big buy area for the move.
Okay, there's a few questions. Let's go. Do you guys look for institutional candles, for example, sell to buy? It's kind of similar to supply and demand. I'm not sure I understand institutional candles.
Yeah, neither.
isn't it the case that order blocks are mostly created during Asia sessions? If you're looking at smaller time frames, you'll notice that Asia session, yes, they do
Yeah.
tend to like range. That's just because volume is muted. Um, what we covered was more on like higher time frames. So like Asia session will just represent a small portion of a specific candle. But if you're looking at smaller time frames, um, Asia does create kind of like a support and a resistance, like a small range, and you can, trade a break and retest based off of that, or kind of wait for a liquidity grab or pull during London session above or below that range, and kind of trade based off of that. Yeah. I tend to look for liquidity zones, and I always find candles below these liquidity zones. I enter off these candles quite powerful. Yeah, that's what we were kind of explaining in those liquidity pool areas.
After 100 pips of profit, do you set your position to break even? I seem to make plus 30 pips and then set stop loss to break even, but then the pair weeks back to my entry, closing me out. Continues the move I was anticipating. Based on liquidity zone, do you enter the top, bottom, or just the middle of it? So to your first question, I can't really answer that question. It's not really a straightforward question, because if you're looking at something like the pound pairs, 30 pips is hardly anything on a pound pair, and you probably will find yourself getting wicked out and then the move happening. Something on, say, like the Aussie New Zealand that barely moves, 30 pips is a lot. So your question can't really be answered in general. It depends. I can't give you an exact figure, and I don't think anybody will be able to give you an exact figure on when to go break even. And that's something you have to develop with every pair that you look at, and you pretty much have to practice and get better at. And you'll be able to tell. So going break even after, let's say, major levels of structure, always looking to the left, once they've been broken, and you know that there's a high probability that the trade's going to keep going and not reverse from that area, is a way to start going break even. And based on the liquidity zone, do you enter at the top, bottom, or just the middle of it? Well, just like you heard me explaining, I chose the 1910 purely on a psychological level and a number. Anywhere in the zone is a good zone to enter. And then based on a lot of things, so this is what I'll go through in the course to my students. There's a lot of ways of picking the exact entries and why you would pick those numbers, why you'd pick those entries. How do you set targets? That's another thing I teach in the course. So targets are all set based on a whole range of things. I have a whole lot of confluence. There's many things that determine when to set, where to set targets and how far to set them.
You don't just set one target, right? Like,
yeah, me and Alex are the type of traders that, and you've probably seen it all over our Instagram. We have things called runners. Runners are when you close part of your position, you leave a remaining to keep going up to another target. And we base these based on a whole range of things.
so essentially we take what we can take from the markets, and then at one point we just leave a position running, eliminating completely our risk. And if it does reach, those extension levels, then it's good for us because we can bank an extra, percent or two or more based on just that little one runner, right? So you can't be greedy in the markets and just be like, yeah, I'm just gonna go for this huge target. I'm not gonna go risk free or whatever, because markets can move in your direction, but then there could be one impact, one catalyst changing the whole direction of the markets, and you'll just either close at break even, making no money, or hitting your stop loss and losing, right? So you don't want a positive trade turn into negative, first of all. And if you do catch a decent amount, based on risk to reward, usually if you're up like 2-to-1 risk to reward, it'd be good to take, a portion out of your position and then leave a remaining running, right?
Yeah.
Anyways, that all depends on your trading.
There's another thing as well. I want to add that I want you guys to start doing is go back on your trades and all the trades that went wrong for you, all the trades where the breakout was a false breakout. I want you to go back, and now with the knowledge that and everything we've spoken about, I want you to go and look at what went wrong, and hopefully now you can actually understand and see the bigger picture of why it went wrong. And Alex, I'm sure you will remember when me and you first got started, we always used to wonder why we got knocked out of certain trades, why certain trades, would pretend or fake break. We didn't actually understand the whole concept back then. We just
Of
thought
course.
markets moved against us, and we thought the brokers were after us, and it's first getting started.
Essentially, if you do want to see improvement in your personal trading, is not like obviously focus on winners, like you want to see what went right. But if you focus on your losers, you'll see so much more growth, because then you can avoid making either the same mistake. Sometimes it's not a mistake, right? It's a game of probabilities, and sometimes it just doesn't go the way it would have supposed to be going. But yeah, also, how do you guys come out of a loss? And I just started trading and blew my account and I feel lost. Well, first of all, losing in trading is part of the business. And if you're blowing an account, you're not following good risk management measures. So you shouldn't be trading more than you shouldn't be trading more than 5% a trade, especially if you're new to the markets. If you're risking 1% per trade, you never be in a position
I'd
where
say even
you're losing
5%.
your entire account.
I'd say even 5% a lot,
I
Alex.
know, I know, but like it's common to see more experienced traders are risking 5% on a trade. But if you're a beginner, like 1-2%, maximum 3%, it tends to be a lot. And when you think of, when you have a large amount in your account balance, I'm not talking about $100 account or $1,000 account. If you're risking, let's say 1% on 100,000, that's $1,000. And if you have good risk management, risk to reward, you can make 2, 3 out of, risking 1%. Now, if you're trading $100 account, yes, you'll find yourself blowing an account because you can't really practice good risk management practices. I think minimum with $1,000, you could probably follow, proper risk management with 1 to 2% per trade. But I'm sure Philip recommends the same thing. We recommend, following good risk management measures, because you don't have to focus. Like nowadays in 2020, there's programs like with Ftmo or Fiverr. There's other companies too that offer funding to traders that do prove that they can trade profitably, consistently, on an extended period of time. So if you're able to manage your risk and profit consistently, whatever you're doing on $1,000 account, $5,000 account, or $10,000 account, which might not be enough for you to live off of that, um, you know, just solely based on trading. Well, if you're able to do what you're doing on a smaller account and replicate it on a larger account with a proprietary firm, if you get funded, you can then, focus on 1-2% that can actually make you a living from, right? So if you really put your focus on risk management and practice patience in the long term, you can benefit from these companies and then really start seeing like money coming in from risking 1 or 2% a trade. Now if you're focusing on making money with $1,000 account or whatever your account size is, you're most likely at some point going to blow it because you're just focusing on dollar figures, and it'll play with your psychology and mindset.
Another thing as well, Alex, on top of the risk management, is how to come out of a loss. Is you should really go back and document everything that went wrong. Write down every trade, why you took it, why it went wrong, and you know what happened pretty much. And then you can reflect on your trades, reflect on what you did, your risk, and that will give you a good idea of what led you to blowing an account. And that in itself will help you come out of the loss and keep trading and move forward.
But the best thing to like get out of a loss is before you even open a trade, you should be accepting the loss coming from that trade.
Exactly. So
Like if you can't accept the loss, you're clearly risking too much. So you're risking an amount that you're not comfortable losing. If from the get-go you open a trade and you accept, you know, the probability of losing what you're risking, you should come out of it at the end fine, because when you're entering a trade, there's always two possibilities, right? Either you profit or you lose, and you shouldn't be risking something you're not comfortable losing. And if you're risking too much, you might get also emotional. If you're sitting in drawdown, you might close the trade a little bit early and then ending up being in a positive trade, but you got out of it because you got emotional, because you start looking at your dollar figures and you start getting emotional. But if you're risking based off of a percentage, you know, relative of your account balance, all this information should be irrelevant, and you should just be sticking to your trading decision that you took in the first place.
And that goes back to the psychology. So if you haven't watched last week's webinar, I actually go into the psychology topic a fair bit. So just make sure you jump on the YouTube and watch the webinar from last week, and you'll understand that the psychology is behind everything in trading. So every over leveraging, over trading, over risking, they're all part of psychology and all part of your mindset. And if you haven't read the blog that I actually posted on my website recently, opestradinggroup.com, I've also wrote a blog too now on mindset and psychology, because both me, Alex and myself both believe that mindset and psychology are some of the key things in trading. They really are.
Yeah. Okay. Can you give me access to share my screen? I'll just I'll jump into my part where I go through my personal experience in my journey in getting funded. So recently, in the last month and a half, I got funded by a company called the 5%ers. And just recently, I think like less than 48 hours ago, I finally completed my verification process with the Ftmo company, and I should be getting my credentials and my funded account in the next 2 to 3 business days. But I'll just go into like tips and tricks on how I kind of managed, you know, my trading plan, how I kind of tackled the risk measures and whatnot, and how you can maybe leverage that and help if you do go through the process, kind of leverage that information and benefit from it. So let's go and share my screen.
That's another thing, Alex, is a lot of traders come into trading thinking that they need a large amount of money. They don't know about these companies that
Companies,
can
yeah.
actually fund you with big amounts of money if you can prove yourself.
Yeah, I'm gonna share the link of this was my phase one, the challenge process. I'll share it in the group so you guys can refer to it whenever you want, I guess. Where's the chat? More chat. All right, so I sent that in the chat. So I'm just gonna go over the Ftmo process. I do have a video on my YouTube about the 5%ers, and if you want more information about it, you can go on my channel and kind of watch it. I think it's like a 7-minute or a 15-minute video, and I think you could benefit from it as well. But anyhow, so with Ftmo, essentially you have to go through it's a 2-process evaluation program, where in the first phase you have, you know, a few trading objectives. So you have to trade a minimum of 10 trading days. So you have to open, you know, minimum 1 trade on 10 separate days. In the trading objectives of this account, I kind of chose the 100K account. So it's all based on the account balance. You can't lose more than 5% of your account balance in a daily period. And it's not just losing; that also includes your daily drawdown. So you can never go over 5% in drawdown or in a loss in a 24-hour period. You can't lose or have a drawdown over 10% at any point in time on your account. And essentially you have to make 10% on the account, so 10,000 in this case. right? So you're allowed 5% a day and a total of 10% loss to make a 10% win in a 30-day period. So the biggest challenge in the Ftmo challenge, in my opinion, is the time frame that you have to accomplish it. It kind of adds pressure on the trader, especially when you're, you know, if, I don't know, like 2-3% away and you have a week left. It kind of puts pressure on the trader on to make, you know, that extra 2-3% to then pass it, right? And I just want to go, like, you can kind of see my equity curve. You know, if you're afraid of losing, like, you can clearly see I've been in drawdown, especially at the beginning of a challenge, which is not cool at all. But you just stay composed, you know, you follow your trading plan, you know that long term you are profitable. Same thing here, you know, we took a loss, but we recovered and we ended up getting the 10% that we needed to pass this evaluation process. I want to go over kind of like my risk, my trading plan. So I think if you risk 2% per trade on an Ftmo account, maybe 2% per day is a good risk measure to follow, especially if you're like intraday trading or swing trading. So by risking 2% with good risk to reward, you can, you know, expect to make 2%, 3%, 4% per trade. And you can see here that I completed in 10 trading days. You can kind of also see this was my last trade. I kind of like left a runner on one trade and really like went for the extension levels and really made a difference in my evaluation process. You can see this is half of my profit target, but you can kind of see like I've only opened, you know, one trade a day. So this was on the 4th of the 4th of August, the 3rd of August, you know, one trade. This was the 31st of July. This was all the same trade. I just, you know, took partial profits. You can kind of see it with the profits being, you know, slightly similar. You know, same thing on the 30th. This was one trade. So I've only really taken one trade at most per day, you know, risking no more than 2%. So if you're looking really to like find success in, you know, trading for a proprietary firm, I think you should focus on quality, like high probability trades, quality trades, and not try to jump on every little opportunity that you see.
What do we
Because
always
if you
say,
do,
Alex?
sorry,
I said, what do we always say? Less is
less is
more.
more.
Yeah.
That's right. And yeah, less really is more. And if I go through, you know, my verification process, you can see, yes, I did the 10 minimum trading days, but for 1, 2, 3, 4 days, 5 days, I really just opened, you know, a micro lot on my platform just to get, you know, an additional trading day on my challenge, because I really just had, you know, this was 1, 2, 3, 4, 5 trading days. And on these days where I didn't open a trade because I might have missed the opportunity to open a trade on that day, or I didn't find an opportunity to enter, I just opened a micro lot, right? Just to add trading days so I can pass this objective. And I don't know if you notice, you can kind of see my last real trade was on the 26th of August. And then on the 16th of September. So like patience really pays off. Less really is more, right? So in this time period here, people might have taken, I don't know, 5, 10, 20 trades. They might have, you know, made money, lost money. Like statistically, you're exposing your account to more risk, and you're more prone to lose the more trades you take. So it's just to show like less really is more. You know, it's not, we've taken a total of 15 trades, including you know, partial profit taking on the trades. So really it was about, I think it was, we first started here, 1, 2, 3, 4, 5, 6 trades, right? To get in the verification process, you just need to make 5% instead of 10, which is a lot easier in a 60-day period. So someone's saying I average 40 to 70 trades per day and it's not healthy, looking at being way more selective. Yes, this is something that, like, I used to scalp a lot before as well, and I used to look at multiple currency pairs and take multiple market executions per day. It could be very profitable at, like, in some days, but on bad days it could take a big hit, and it kind of plays with your psychology, your mindset. So with kind of like having this idea in your head where less is more, and you take 1 trade per day or maximum 2 trades per day, you know that if you lose, you just close your terminal and you come back the next day, right? But same thing when you win. So if you win a trade, you kind of you take it as like a good day. You close your terminal, you go enjoy your day, you know, work out, I don't know, spend time with your family, your girlfriend, do something good for your brain, right? And come back at it the next day or the day after. Don't go and risk your profits just because you have profits. People say, like, yeah, I'm just risking my profits, but profits are profits, and profits end up being your money as well, right? Fundamental wise, do you use news data such as ROM MyFX book, or do you have another source of information, news headlines from? So we are, and I think I speak for Philip as well. We do look at economic calendars. Let me unmute Philip because, okay, unmute.
Yeah. Oh, yeah. Sorry, muted me because
Yeah. So I was speaking for yourself as well. We do keep an eye on economic calendar. So you do want to know when, you know, high impactful news are about to happen, because when there is high impact news, it usually takes over technical analysis. So your support resistance, or like supply and demand or trend lines or whatever you use on a technical analysis basis, if there's high impact news, your tech analysis is not going to mean much. And you know what I mean? So you want to be aware of when there's such information coming out in the market, so you can, you know, reduce your risk or avoid trading at those times. A lot of people, I guess, like, you see like those gurus on social media telling you, like, learn how to trade NFP, blah, blah, blah. Well, let me break it to you. You don't trade NFP. You don't trade high impact news. You wait for the news to come out, and then you make a trading decision, you know, after the actual reports out, and you kind of have an idea of where the market's going to go based on the information that came out. Unless you're in a trade before the actual news and you can eliminate your risk, that's the only way you can really trade a high impact news event and profit from it. Or
there's a whole section in my course about trading news and the exact ways, to trade news. And I believe both me and Alex never trade the actual news itself.
I mean, don't get us wrong. Like, we have had experiences when we first got started where we were actually trading news because we didn't know any better, right? So take this from like more experienced traders. Avoid trading news is a good thing. You'll save money in the long term. Like,
Alex, I'm reading an interesting comment. I average 40 to 70 trades per day, and it's not healthy. Looking at being way more selective definitely plays with my mental state, which is the most important thing. Yeah, Danny, 40 to 70 trades per day is definitely a lot of trades. I would call that over trading. I'm sure Alex would call that over trading. And
I don't even take 40 trades in like this, I don't know, a
a
6 month
month,
period.
yeah, I would definitely think that is affecting your mental state. It would definitely affect mine too.
anyways, that was pretty much it for my FTMO, right? So just to show like good risk management, being selective with your trades, and good risk management, not risking too much, not risking too little. So if you plan on taking more trades per day, maybe lower your position size, right? I know that I only take one trade at most, two per day. So if I'm taking a second trade, I'll make sure like I'm in profits, or maybe like it was a really selective trade and I just couldn't ignore it. But mostly I take one trade at most, and I know that I'm only exposing the account for no more than 2%, right? So the 5% daily maximum loss is not an issue for me. And unless you're very unlucky and you lose, 5 trades in a row and you take a full loss on each trade, then you'll hit the maximum daily loss. But that's part of trading, right? It could happen. But if you're selective with your trades and you have tight risk management and you see price action not really going in your favor, you can always take a partial loss, which avoids taking, a full 2% loss. It could be 0.5% or 1%. As you add trades, it kind of plays with your overall risk to reward. So, those are all good practices to have, especially when you want to get funded. So I think most importantly, kind of like take your real accounts or your demo accounts seriously when you look at risk management, because then you can apply the risk management that you've learned on your smaller accounts, and then you can apply them on the large accounts. So if you don't focus on dollar figures and you focus rather on percentages, anything relative to your account balance, then trading big lot sizes on larger accounts shouldn't affect your psychology, because it's just 1 or 2%, just as if you were doing it on $1,000, $5,000, $10,000 account, right? It's all relative to your account balance.
What you should all be doing as well is setting, strict risk measures, a strict set of rules, and being disciplined with yourself to follow these rules. And at the end of the day, you have to realize that it's you against yourself. If you break those rules, you're only hurting yourself and nobody else. So that's another thing that every one of you should have, is a strict set of rules and parameters that you're never going to deviate off. And that's what I like about FTMO, is the challenge in itself actually gives you those rules and you can't break them. Otherwise you fail the challenge. So that will help you be a disciplined trader. And the fact that you're putting up your actual money on the line to enter the challenge will make you take it seriously.
Mm-hmm. And I want to add something about the FTMO requirements and like the objectives. So a lot of people don't know that. And when I kind of got that piece of information, it kind of like made me more attracted to their kind of like business model. So essentially, in the challenge, in the phase 1 of the evaluation process, you have 30 days to reach those trading objectives. However, if you are passing all the objectives except for the profit target by the time your 30 days is over, so as long as you've respected the 10 minimum trading days and you haven't broken any of the the max daily loss or the maximum loss, and your account is either at par, so 100,000 or more in positive, it could be 1% up in profit, you can get a free repeat. So you don't have to pay again the evaluation process fee to then trial again, right? So me personally, I took 2 challenges before I actually passed it, and I've only paid that one time, right? So with my first challenge, I was kind of getting used to like, okay, how much should I trade per, how much should I risk per trade? And I remember I was risking like 0.5% and then 1%. And like, it was hard to make that 10% in a 30-day period. So I think at the end of 3 weeks, I was slightly above par, and I was like, you know what? I'm not going to make 10% in 1 week. I'm just going to wait for my next month so I can have, a full 4 weeks of trading to then, rectify my risk management, my trade management, to potentially get a better chance of passing, right? And without having to pay again for a challenge. So if I go in the second trial that I did, I was very close to putting it. It was, I think, up like at 7.5%. However, in my last week, I did feel the pressure on, you know, getting that extra 2%, and it did go sideways. However, I did choose to, you know, I made sure that my account stayed above par before the 30 days end. And, you know, I was able to get repeated once more at no charge. And then, you know, finally we did pass it after 3 months, right? So it's not a sprint. You don't have to rush the process. You know, if things aren't going your way and you rather wait, you know, the next month to repeat it, you know, take your time. There's no rush in getting funded. It will be worth it once you do get funded. Anyways, that's pretty much it for me. I don't know for you, Philip. Did you want to add anything?
No, I just wanted to see if you guys have any questions or any comments that you'd like to leave in the chat. Is there anything? So, like I said earlier, this will all be recorded, posted on YouTube, both Alex and I's YouTube channels. If there's any questions, you guys can ask us on our Instagram pages. So Maroon Forex for Alex, Philip.Saloom, or Opes Trading Group for myself. Yeah, I hope you guys enjoyed today's webinar. If there's
It's more of like a discussion type of webinar, which I liked, and we're able to answer some questions.
If you have any topics that you guys would like us to do for another webinar, also please come forward and ask us.
Yeah, sometimes we kind of, I mean, we could easily neglect some topics that
We think
wouldn't,
aren't worth it.
yeah, but might be, you know, for beginners and stuff or less experienced traders.
All right, we'll wrap it up.
Okay, thanks for coming, guys, and see you on the next web.